What's good, everybody? It's Chase Lawson. This is the Financial Freedom Show where I make personal finance simple. Thanks for tuning in. Today is the third and final part of this three-part series on stock market and investing. If you missed the earlier parts, hit that notification above. Check them out. Today I'll conclude the series by discussing the different types of investments, how and where to invest, what to look out for, as well as some of my top investment recommendations for you. So make sure you hit that subscribe button so you can stay updated when any new videos get released. And be sure to comment below and let me know what else you're curious to know about when it comes to personal finance. Enjoy.
Great. So now that you know how to read stocks and a stock chart, how do you actually go about investing? And what are some different vehicles to invest in? So when it comes to investing, there's a few different vehicles to actually go about doing so. There's a 401k, there's an IRA, there's individual stocks, mutual funds, index funds, and ETFs. So 401ks and IRAs are both retirement accounts. 401k is through your employer. An IRA is an individual retirement account that you set up on your own outside of your employer. Now, both of these accounts are great accounts. For one, as I mentioned, they're retirement accounts. So they allow you the ability to save and invest for retirement and grow that money over a long-term horizon. And in addition, with it being a retirement account, there's a lot of tax advantages as well to save you money on taxes on the growth of those accounts. Now, with it being a retirement account, though, there are a lot of restrictions and limitations with each of these, whether it caps the amount you can invest per year into each of these, or when you can actually start withdrawing money. If you withdraw money before you reach a certain age, you will incur a penalty. In addition, you may be required to start withdrawing money from one of these funds when you hit a certain age as well. So keep that in mind. There are restrictions and limitations on it, but it is great. They're both great vehicles to invest for retirement with your long-term dollars. With a 401k, you're oftentimes limited to a handful of mutual funds that your employer has set for you to invest between. Whereas with an IRA, you're oftentimes have a lot more freedom and flexibility to invest based on what the individual broker has available for you to purchase. So some key differences there. But when it comes to non-retirement accounts, there's really a few different ways to do so. As I mentioned, you can buy individual stocks. Now, this is certainly a risky way to invest, and I don't recommend it for beginning investors. I don't even recommend it for more experienced investors. Because when you buy individual stocks, you need to understand industry trends as well as stay afloat of news about that individual company or companies that you're buying stocks in. In addition, like I mentioned, it's a lot riskier. So if a particular company you invest in goes out of business, you will lose all your investment. But obviously there is the chance that that company really crushes it and does really well, in which case you can make a lot of money on that investment. So that can be appealing, but once again, it's putting more of your eggs in one particular basket, which is riskier. So I don't recommend that. Instead, I recommend one of the following types of accounts: mutual funds, index funds, or ETFs. So a mutual fund is an investment program that pools money from lots and lots of investors to buy a number of assets like stocks, bonds, and other securities. The goal of mutual funds is to achieve income or growth, and mutual funds are professionally managed by an active fund manager that will buy and sell its holdings, pretty consistently, with the goal being to outperform the market. Now, with a mutual fund being actively traded by a fund manager, they oftentimes carry a higher expense ratio that you pay as owner to that fund. But as I mentioned, mutual funds try and outperform a particular index or the market, so they justify the additional fees based on their performance. But on the other hand, there are index funds that are a special type of mutual fund that's more passively traded. So an index fund, as the name indicates, tracks a particular index, for instance, the S&P 500. And essentially what they do is they buy stock in all of the companies that the S&P 500 invests in at the same relative weights. So, however the S&P 500 is performing, your investment in an S&P 500 index fund should be pretty close, within plus or minus less than 1/10 of a percentage point there. So, these track a particular index and provide similar returns. So that can be a great way to invest. And since they're passively traded, you don't have the active fund managers involved there. And so they carry a lower expense ratio. So, less in fees that you're having to pay. Now, with index funds and mutual funds, one downside is oftentimes they require a minimum upfront investment to get into a particular fund. So if you're just getting started out and you don't have a lot of money, you may not be able to get into one of those types of funds. So if that's the case, there's also what's known as an ETF, or exchange traded fund. So an ETF is just like an index fund in that it holds a number of assets like stocks, bonds, commodities, and other currencies. Only they trade just like stocks. So mutual funds and index funds are not actively traded throughout the day. The price changes at the end of the day based on how the individual companies they hold perform that day. But any investors that buy or sell on a particular day, it's based on the closing price for that day. So you won't see an index fund or mutual fund's price change throughout the day, whereas in an ETF, they're actively traded. So you'll see the price going up and down throughout the trading day based on how the companies they hold are performing. In addition, ETFs don't have a minimum investment requirement. The minimum investment to get in is just the cost of one share. So great way to get in if you're just getting started out and don't have a lot of money to invest. But the great thing about mutual funds, index funds, and ETFs, like I mentioned, is they allow you the opportunity and ability to be really diversified. For example, let's say you're interested in buying stock in Amazon, Apple, and Facebook. Currently Amazon is trading for about $2,300 a share. Apple is almost $300 a share, and Facebook is almost $200 a share. So just to own one share of stock in each of those three companies, you're going to have to put up almost $3,000. So that's a lot of money for not a whole lot out there. Instead though, if you look at an index fund, for example, VTSAX, which is the Vanguard Total Stock Market Index Fund Admiral shares, you can get into that for less than $70 a share. And VTSAX holds 3,535 stocks currently. So for less than $70 per share, you can have partial ownership in over 3,000 different companies. That is very diversified. But as I mentioned, with VTSAX and other index funds, there often is a required minimum investment amount. With VTSAX, it's $3,000. So if you don't have that much money to invest right now, another alternative is VTI, which is the Vanguard Total Stock Market ETF. It's just like VTSAX. It holds the same 3,535 stocks, only it doesn't have the minimum investment amount. One share of VTI is currently trading for about $145 per share. So if you only have a few $100s to invest, you can probably buy a few shares of VTI and have that investment be spread across over 3,000 different stocks. As Warren Buffett, who's very famous and has made a lot of money in the market, and people trust his opinion when it comes to investing in the stocks he owns, he's famously said that a low-cost S&P 500 index fund is the best investment that most Americans can make. And I agree with that. And there's a reason why that I'm heavily invested in index funds and ETFs as well. But the main thing I want to leave you with here is that you don't have to have a lot of money to start. You don't have to start big. These days, you can get started with as low as $5. But the important thing is to get the ball rolling now. The biggest thing that a lot of you watching probably have in your favor is time. If you're younger and you get started now and have a long time horizon to make money, you're going to make a lot of money over the long term. As I talked about in my video on coronavirus and investing, long-term returns on the market, you can safely, make about 7 to 10% yearly returns on the market, over a long-term horizon. So get started today, whether it's $5 or $500, just get started and make investments. Now that you know the different vehicles to invest, How do you actually do that? Where do you buy them? Do you just go on Yahoo Finance and click buy this company? No. There's a couple of different options. There's brokers and there's Robo Advisors. So there's a number of online brokers available, and they can be either full service or discount. Full service brokers, as the name implies, give you a full range of additional services like financial advice for retirement, healthcare, and everything related to money. But typically they only deal with higher net worth clients and oftentimes require a minimum account size of $25,000 and up. In addition, they charge substantial fees for their services, such as a percent of your transactions or a percent of your assets under management, or even a yearly fee as well. So it can be pretty costly for this. Most investors do not need a full service brokerage. I don't use a full service brokerage. I use what's known as a discount brokerage, which basically is now the norm. They give you all the tools to ultimately select and make your own investments on your own behalf. And a lot of them offer robo advisory services as well. And as we progress throughout the 21st century, online brokers have continued to add more and more features to their investors like me and you to be able to leverage. As I mentioned, I have my investments across a number of platforms. I use both brokers and Robo Advisor. When it comes to brokers, I use both Vanguard and Fidelity. Both have different purposes with them, but both are discount brokers. They may have full service brokerage services as well, but I don't need that. So I do everything I need to, with the discount brokerage offering. I don't have to pay a fee for assets under management or any of those fees as well. But in addition, like I mentioned, there's what's known as Robo Advisors. So Robo Advisors have become really popular here lately. And what they do is they have an algorithm that will ultimately make investment decisions for you based on your preferences, your risk tolerance, your goals. So it can be a great way to get started investing. Whenever you invest money, they'll continually buy and sell shares to rebalance your portfolio to ultimately hit your goals and objectives with the account. And they'll do cool things like what's known as tax loss harvesting to save you money when it comes to taxes. So for Robo Advisors, I currently use Wealthfront, and I've had great experience with them. Like I mentioned, they will ask you questions to understand your risk tolerance and your goals and objectives and allow you to get invested, across a diversified portfolio. So something to look out for. So when it comes to investing, there are things to be aware of and keep in mind as you're trying to sort through various brokers or Robo Advisors. The biggest thing is, what are the commissions and fees they charge? So some brokers will charge you a commission for every transaction you make, whether it's buying or selling. When I started investing through Vanguard. At the time, their per transaction fee was $7. So for example, if you invest $100, you would have to pay $7 when you buy stocks with that $100. And then $7 again when you sell those stocks down the road. So that's $14 in fees on $100. That's pretty costly. That's 14% of your investment. At the time, that was among the lower end of the fee range. But nowadays, especially due to the launching of a lot of these robo advisors, a lot of these brokers have completely eliminated their per transaction fees. So you're not paying a commission on every trade that you make. For example, a few months back, I noticed on Vanguard that they had joined that revolution and they don't charge a transaction fee when you buy and sell stocks. So that's great. That provides you ways to really maximize your earnings. You're not having to pay those fees every time you buy or sell securities. Find a broker that doesn't charge a commission on each of your transactions. Nowadays, there's a lot of brokers that are like that. Vanguard being one, Fidelity being another. Like I mentioned, I'm invested in both of those. In addition, like I mentioned, with mutual funds, a lot of times they charge you an expense ratio. So mutual funds that are actively traded will carry a higher expense ratio than index funds typically. But just be aware of what the expense ratio is. They will list it out on their website, so you can kind of see what that looks like. But these expense ratios can really eat at your earnings. Just to put it in perspective, let's say you invested $10,000 today and you were able to earn 7% annual return on that investment for 30 years. If you did not make another investment again into that account and just let the $10,000 grow, at the end of 30 years, that $10,000 would grow to $76,000. Now, if the expense ratio is 0.25% or 0.25%, you'll pay about $5,000 in fees, bringing you about $71,000 net on your $10,000 investment at the end of the 30 years. Now, if the expense ratio was even 0.25% higher or 0.5%, that's $76,000 you'd have to pay almost $10,000 in fees on. So it would be worth only $66,000 at the end of 30 years. So, you're paying about $5,000 extra, on about $70,000 just by 0.25% additional expense ratio. So be aware of what the expense ratio is, because obviously the lower the expense ratio, the more of your earnings you get to keep. In addition, some mutual funds may charge what's called a load. It could be a front-end load or a back-end load, which basically means when you pay a certain fee. So a front-end load front loads the fee, a back-end load back loads the fee, so you pay at the end. There's a lot of mutual funds that have no loads, so try and find one that doesn't have a load, because once again, any fees you have to pay will eat at your earnings as well. In addition, when you invest money in a taxable account, which is any account that's not one of those retirement accounts we talked about before, you are liable to pay taxes on the growth, any income that you make from those investments. You're only liable for paying the taxes when you actually sell those holdings and realize that money. So like I mentioned, long-term horizon is definitely recommended, not just for being able to capitalize on the long-term growth of the market, but also due to taxes. So if you hold a stock for over a year, you only are subject to long-term capital gains tax on the growth of those investments. So if you invest $1,000 today and it grows to $1,200 and then you sell it, you have to pay taxes on that $200 growth. If you held it for over a year, you pay less in taxes. It could be 0%, it could be 15%, or it could be 20% depending on your income. Whereas if you sell it within the first year of owning it, you pay your normal tax rate, which is going to be higher than the long-term capital gains tax rate. So keep in mind, invest and hold it for more than a year so you'll pay less in those taxes as well. Now you know pretty much everything you need to know to get started to invest. These tips will be able to get you where you need to be when it comes to investing, and just follow these tips and strategies and you will make a lot of money. But lastly, I wanted to leave you with some of my recommendations for different funds or ETFs that you can get started investing in that should make you a lot of money. So, as I mentioned, I started investing in Vanguard. I do have a preference for Vanguard funds. So all these recommendations I'm going to make are different Vanguard index funds or ETFs, for a reason. Vanguard actually in 1976 launched the first ever index fund for regular investors like me and you. So they were a pioneer in this space. They've been doing this for the longest. In addition, they have performed really well over the years and carry a low expense ratio as well. In fact, their average expense ratio for their funds is only 0.19% compared to the industry average of 1.08%. So you're going to pay a lot less in fees on average with Vanguard than with some other brokers out there. In addition, when it comes to performance, obviously you want to invest in things that are going to do really well over time. So nearly all of Vanguard's funds have outperformed similar funds over both a 5-year and 10-year period. So they have about an 86% outperformance over the past 5 years and about a 94% outperformance over the past 10 years. So Vanguard has low expense ratio and outperforms similar funds. So that's a double bang for your buck there, win-win there. Now, you don't have to invest through Vanguard to buy Vanguard funds. Vanguard does have relationships with other brokers to allow you to buy their funds through other brokers. So when you're looking at potential brokers, you don't have to go just Vanguard, but do keep in mind that Vanguard funds do really well and are worth your attention for potential investment. So there's a few that I want to recommend, as I mentioned. So one is VTSAX, like I mentioned, which is the Vanguard Total Stock Market Index Fund Admiral shares. This carries a very low 0.04% expense ratio, but it does require a $3,000 minimum investment. Another index fund to consider is VWUSX, which is the Vanguard US Growth Fund Investor Shares. This carries a slightly higher expense ratio at 0.39% and also requires a $3,000 minimum investment, but it's performed really well over the past 10 plus years, so I definitely recommend that for your consideration. If you don't have $3,000 to invest, like I mentioned, you can invest in an ETF, which allows you to be diversified but not have a minimum investment amount. So there's a couple that I would recommend there, including VO, which is Vanguard Mid-Cap ETF, which carries a very low 0.04% expense ratio. It invests in a number of medium-sized companies, and like I mentioned, no minimum investment requirement. And then VTI, which I talked about previously, is the Vanguard Total Stock Market ETF, just like VTSAX, and that it holds over 3,000 different stocks, but carries a 0.03% expense ratio and does not have a minimum investment amount required. And then last but not least, Vanguard has a number of target retirement funds, or TRFs. For example, VTTSX is their Vanguard Target Retirement 2060 fund. So this is geared for people who are planning to retire around the year 2060. So if you're around 25 or 30 years old, this could be something to look out for. They have other target retirement funds for other years like 2055 and 2050 and before, and they may have ones for 2065 as well. But their target retirement funds are great investment vehicles. The great thing about target retirement funds is that they will rebalance the portfolio over time as you age and get closer to retirement, so that as you get closer to retirement and closer to needing that money, you're invested less in the riskier assets like stocks and invested more in safer assets like bonds. Because obviously as you get closer to retirement, you need some stability with that money. If another situation like coronavirus happens where we enter a bear market and the market tanks, you don't want that to eat your whole investment returns alive when you're about to need to pull that out for retirement. So they'll rebalance the portfolio into safer assets when it makes sense to do so, when you're closer to needing that money. Their target retirement funds typically have about a 0.15% expense ratio and only require a $1,000 minimum investment as well. So something to consider as well. I'm going to put all of these recommendations in the description below for your convenience. So take a look below in the description to see what those recommendations are.
Thanks so much for watching the third and final part of this three-part series on investing in the stock market. I hope you enjoyed it and took some good notes and are ready to start investing today. It truly is a great way to make a lot of money and set yourself up for a great life. So be sure to share this with anyone who you think could benefit, as well as subscribe and hit the notification bell below so you don't miss out on any future content. Let me know in the comments below as well what other topics you'd be interested in me covering. And if you enjoyed this video, once again, please hit that thumbs up button so that I know you're getting something out of this and that I can continue to put out more great content for you. So thanks everybody, and go get them.